Welcome to Lesson 9A, Accounts Receivable, the Big Picture. What is an account receivable? An account receivable is created when a company that sells goods or services by agreeing not to take cash when the goods or services are delivered or sold. Rather, they tell the customer, you can pay us later according to certain payment terms. So, the big picture here in Lesson 9A is to just introduce you to some new terms and to a few new accounts. So let's start off by opening up a spreadsheet called the direct write-off method. Now, if you look at the spreadsheet, you see that this company starts with $500,000 in cash. It has an account here called Accounts Receivable, which is 0. There's another account here called the Allowance for Doubtful Accounts, and we'll explain what that is a little later, but that is also 0. This company has one bicycle in its inventory, and this bike costs $500. To make sure that our total assets of $500,500 equal our liabilities and equity, let's compare the right-hand side of the equation here. Contributed capital is $499,000. Retained earnings is $1,500. So we start off with a balance sheet that balances. Now, when this company decides to sell this bike, it's going to sell the bike for $1,000. So the selling price is $1,000. When we record the sale, the asset accounts receivable goes up and the revenue account also is increased. If we were using debits and credits, we would debit the asset since the asset went up and increases in assets go on the left. We would credit retained earnings hyphen revenue because retained earnings goes up, as we know, through sales of goods and services. So debit cash, credit revenue, but in our database we simply add to accounts receivable, add to retained earnings. Now, this company uses the perpetual method of accounting for inventory. And so when a bike is sold, we've got to subtract it from the inventory account. Here's where you see the less 500 for inventory. And we subtract 500 from retained earnings. Now, if we were using debits and credits again, we would credit inventory and debit cost of goods sold. Now, if for some reason, if 30 days or 60 days goes by and we can't collect that account receivable right here, we would write it off. And the method I'm going to show you right now to write off a bad debt is to subtract from the account receivable, but we're going to go directly to retained earnings and write off that as a bad debt right there. So the direct write-off method we'll learn in a moment is not acceptable according to generally accepted accounting principles, but we teach this method to begin with because it's somewhat intuitive that if an account receivable is written off, when you reduce the asset, accounts receivable, it's natural to want to reduce the retained earnings and call it bad debt expense. That's acceptable for companies that don't comply with GAAP. But for now, let's just write off the account receivable and subtract $1,000 from retained earnings, and we would call that bad debt expense. And another name for bad debt expense is uncollectible accounts expense. Now, during the year, we buy one bike every day on average. So during the year, we're going to buy 365 bikes. So if we pay cash for that, and each bike costs $500, we're going to subtract $182,000 from cash, and using the perpetual method, we're going to add $182,500 to inventory. If you recall from our inventory discussions, when you add to inventory, when you buy inventory, by increasing the inventory account directly, we are employing the perpetual method. Now, during the year, let's say we sold 364 of those bikes at $1,000 each. If all sales occurred on account, meaning it was a, quote, credit sale, accounts receivable goes up, debit, we're going to credit revenue. If we sold 364 bikes, we then must remove all 364 of those bikes from inventory. Hence, 364 bikes times 500 is 182,000, and we subtract the same amount from retained earnings as cost of goods sold. Now, during the year, we increased receivables by 364,000, but we collect most of them. If our credit policy is fairly sound, most of the accounts receivable will turn into cash during the same period. And hence, when cash comes in from our customers, we increase cash and we reduce accounts receivable. Now, let's summarize. When we make a sale on account, accounts receivable increases and revenue increases. Using the perpetual system, inventory goes down and retained earnings goes down. When we write a customer off using the direct method, we subtract from account receivable and we subtract from retained earnings, and we call that bad debt expense. Then, as we buy more bikes, we would reduce cash and add to bike inventory. When we sell them on account, accounts receivable up, revenues up, just like we did for this bike right here, the very first bike. And then, of course, when we collect from customers, cash will go up and accounts receivable will fall. When all is said and done, we're going to have an ending balance this year of $20,000 in accounts receivable. We started with zero. We sold 365 bikes. We wrote off one account receivable. We collected the vast majority of the rest, but at the end of the year, customers owe us $20,000. We had started with one bike. We sold it. We bought 364 more bikes, so we had 365 bikes, and then we sold 364 of them. So we ended up with one bike in ending inventory. On our financial statements, we would show accounts receivable of $20,000 right here, and we are not using an allowance method here, so the allowance account we'll learn in a few moments when we use the aging or percentage of sales method. But right now the allowance is zero. So in our balance sheet, we would show accounts receivable at net accounts receivable, sometimes known as net realizable value. Now our income statement presentation takes all of our revenues during the period, which summed to $365,000. We subtract our cost of goods sold, which is $182,500, to get what is known as gross profit. And another name we know for gross profit is gross margin. Now the only operating expense here is our bad debt expense, which we wrote off one customer for $1,000. So we would subtract that operating expense right there to get net income before tax of $181,500. This concludes our first lesson, lesson 9A, accounts receivable, the big picture.